All right. Good morning, everybody. Um, it is 10 o'clock, so to respect everyone's time, I'm going to go ahead and get started. Welcome to Everhard Advisors University. Today we're talking about basic wealth. My name is Clark Engel. This topic has been a staple of our university program. We've gone through this topic in January of every year the last several years. So if you've attended one of these in the past, hopefully a nice refresher for you. There are, a few changes in here, so maybe some new information as well. But our thoughts on building long-term wealth for yourself are pretty consistent. It's we want to look at how people have done this over the last 100 plus years and help you learn how to do that. So we're through the holiday spending period. Maybe you've got a New Year's resolution to focus on your finances, or you're just feeling a little down in the dumps after spending a bunch of money through the holidays. So maybe a good time just to talk through, building wealth and setting ourselves up well for the future. So I want to start just by defining wealth. What is it? It's really defined as having a great deal of money, resources, or assets. So, pretty generic there, but the way that we would look at somebody's wealth is a term called your net worth. So you get to your net worth by taking your assets, anything that you own of value, minus your liabilities or your debt, which would be money that you owe to other people, and that's going to give you your net worth. So historically, a net worth of $1 million has been considered wealthy. Now, a couple points I want to make here. One, I would define increasing your wealth over time, not just as having more money, but increasing your purchasing power. So what's the difference there? Maybe a nice example would be, let's say it costs you $100 a week to go to the grocery store. And you set aside $100 that you're going to use at the grocery store 12 months from now. Maybe a silly example, but I think you'll get the point. So let's say it costs $100 today per week, but next year in January, it's going to cost you $105 per week because of inflation. Grocery prices have gone up by 5% in those 12 months. So if you sat on that $100, you still have $100 when next year rolls around, right? But it's going to cost you 105 to get your groceries. So in that case, your purchasing power has declined. Your money does not stretch as far. You cannot pay for that full grocery bill. If instead you would have grown that money to $105, your purchasing power has stayed the same. So you haven't necessarily built any wealth, but you haven't lost it. And if you grew that $100 to $110, now your purchasing power has gone up. So I think purchasing power is really the key thing to consider here, because if we're not outpacing inflation with our investments, then we can't buy any more stuff, right? Our standard of living is not going to change. If inflation's running at 3 or 5% a year, and that's all that we're increasing our net worth by, we're not really building significant wealth for ourselves. And also that $1 million number, for quite a while now, people have considered $1 million to be wealthy. But again, if you think about just cost of living increases, that purchasing power of $1 million is also declining over time. $1 million does not stretch as far today as it did 10 years ago or 20 years ago. Historically, inflation has run at about 3% per year, which is going to double our cost of living every 25 years, which sounds kind of crazy, but if you look at the year 2001 compared to 2026, we've had a double in cost of living. So really important that we are investing our money in some way. We'll talk through the different ways to invest and build wealth, but I want to stress the significance of it there. Why are we doing this? Really a few common reasons would be just creating financial freedom, retirement, maybe you're charitably inclined or you want to leave money behind as a legacy to your kids. I really like the financial freedom one here. Um, I'm not at retirement point yet, and I'm in the process of building wealth, but I can imagine it's a great feeling knowing that I'm debt free heading into retirement. I've built up my 401k or my brokerage account, or I've got some real estate that I'm generating income off of. I don't have to rely on anybody else to support me. I've built up my assets and paid off my debts to the point where I have significant net worth and I can live off of that. That's has to be a very powerful feeling. So we want to help you get to that point. So we looked at, assets minus liabilities equals net worth. This is an example of a balance sheet, a little small, but hopefully you can see it. This is an exercise that we go through with our clients. So I would suggest that you take a little time to do this yourself. I update my personal balance sheet for my wife and I at the end of each month just to, see what happened over that month. But you're going to list everything that you own on the left-hand side, and then everything that that you owe money to other people or the bank on the right-hand side as your debt, and you're going to calculate your net worth here. So examples of assets here, we've got Mark and Kristen who are 45 years old. They've got $18,000 in checking and savings. They've got a CD at their bank for 50,000. They each have a 401k that they're contributing to. They've got a Roth IRA as well. And then they own their home for $500,000 there at the bottom left. They've got a rental property uh, that they generate income off of. They each own a car and they have a boat. Okay, so their total assets in that blue bottom left is a little over $1.2 million. But that's not their net worth because they do have significant debt here as well. So they owe money on both of those properties. They got a car payment. One of them still paying on student loans, and they have credit cards as well. So, couple maybe high level thoughts on this balance sheet. Credit card debt is really the biggest um, debt that we want to try to tackle aggressively because you look at that interest rate, 25% is a pretty typical interest rate on credit cards, costing you a lot of money to have a revolving balance there. Um, we are proponents of using the snowball method to take care of non-mortgage debt. So very simply, the snowball method is you list out every single one of your debts besides your mortgage, from the smallest balance to the largest balance. You're going to make the minimum payment on everything except that smallest balance. You're going to pay it off as quickly as possible. So every month, with any money that's left over, you're putting it toward that smallest balance. Once that one's paid off, you're going to take what you were putting toward that one and lump it onto the next smallest balance. And you were already making the minimum payment there, so it's a little bit bigger amount that's going there. Pay that one off, lump it onto the next smallest balance. You can build some momentum doing it that way, okay? And the focus of today is not debt strategies, but I want to, touch on that for a second. And then, a couple thoughts on criteria for taking on new debt. So you want to make sure, the economic benefit to you is greater than the cost of borrowing it. So typically good debt is going to appreciate or go up in value. Bad debt's going to go down in value. So, having a mortgage is typically considered good debt because your home is increasing in value. You're building equity in that house. But just owning your home is not, a fast growing investment, I would say, because home prices have gone up by about 4% a year. So when I talk about real estate a little bit later, it's really rental properties and generating income off that. if you've got a big car payment, bunch of credit card debt, student loans, that may prevent you from building wealth, right? So if you've got a certain amount coming in after taxes from your paycheck every month, and 40 or 50% of that paycheck is going toward paying off debt on all of the things that you've bought, well, then you've still got your necessities like housing costs and utilities and food and clothes and gas. There's probably not going to be much left over, if anything, to save for future goals. Okay, so getting this debt under control is really key. Make sure you've got a reliable payment plan. Talk to your spouse. Finances is one of the leading causes for divorce in this country, and you want to be, free from anxiety. Make sure you've got a payment plan set up. Make sure you're both on the same page. Building wealth is not just avoiding debt, living on a budget, or having a lot of money. This can help you build wealth, but by themselves, they do not build wealth. If you avoid debt or live on a budget, but all your money's sitting at the bank, earning you 1% interest, you're not building wealth. If you have a huge income, but you're spending all of that money or you've got a ton of debt, you're not building wealth either. So, um, we'll talk through really the three main ways that people have built wealth in this country. But first, um, quiz here. You have a household that's making $75,000 a year and they're saving 15% of their income, which is, you know, we like to see a range of 10 to 15% for retirement. So that's on the high end. But they're saving that 15%. They're just putting it in the coffee can. So it's not growing for them. How long is it going to take them to save $1 million? Okay, take a guess in your head. It's going to take 88.9 years. So if you start saving at age 20, let's say, you would not save up to $1 million until you're 108 or 109 years old. That's that's not going to work, right? That's going to take way too long to generate wealth, and you're saving a high percentage of your income. So how is it that 80% of millionaires in this country are first generation? So they did not inherit their wealth from their parents or anybody else. They built this on their own. And we hear about, Jeff Bezos, Elon Musk, all these people that have built crazy wealth, and it's typically from starting and running a small business. And there are a lot of Americans that build wealth running a small business, but there's also a lot of us that save into our 401k or other investment vehicles. So for those folks, there's still a ton of people that become millionaires that way, but it's not taking them 89 years. Well, it's the eighth wonder of the world, compound interest. Okay, you've probably heard of this phrase. Hopefully, you're familiar with it. But the idea here is you are generating interest on your investment, but then that interest is generating interest, and then the interest on your interest is generating interest, and it creates, this simple interest line is linear and the compound is exponential. It's not going to look exactly like this in real life because you see, up and down movements each year on your investments, but this is the idea. Your growth would accelerate later in your career. Okay, so if you've got $10,000 sitting in your 401k and it's invested in stocks aggressively, and you get an average year in the market, you get a 10% return. That's $1,000 of growth on that $10,000 investment. So now you have $11,000 in your account. Well, if you keep doing that for years and years, and now you have $100,000 in your 401k, that same exact 10% return gives you $10,000 of interest instead of just the $1,000. So you didn't do anything different. You just accumulated money in that account over time. You contributed toward it. And you benefit by generating a bigger amount of interest on that higher principal. Okay, I love this rule of 72. It talks about compound interest. Um, when we get into the different types of building wealth, we'll kind of talk about different rates of return that you could expect to generate from each one. So this rule of 72 is a simple math trick to figure out how quickly you can double your investment. All right, so you're going to take 72 and divide by your annual rate of return, and that's going to tell you the number of years it takes to double your investment. So if you averaged a 4% return, uh, you know, people's houses have grown by about 4% a year. Bonds have probably generated 5% a year on average, so that would be close. But 72 divided by 4% a year is 18 years. So it would take you 18 years to double your investment. So 100,000 would grow to 200,000 in 18 years. But if you got a 10% annual return, now it's only taking you 7.2 years to double your investment, and 18% takes you 4 years, a lot quicker. Probably thinking, how do I get an 18% return on my investment? Um, typically that is accomplished through small business ownership or real estate investing. When you look at the stock market, so investing in your 401k, if you own majority of stocks in there, which is just owning companies through the funds in your plan, that is averaged about 10% a year. All right. So maybe go through that exercise yourself. If you are 45 years old and you plan to retire around the age of 65 and you're invested in stocks, it's going to take you 7.2 years to double your investment, right? So you have time for about three doubles in those 20 years. So if you have $500,000 sitting in your investment at 45, that could double to $1 million. Then it would go to 2 million, then it would go to 4 million by the time you retired at 65. So those doubles get bigger, the dollar amount gets bigger as you get closer to retirement there. I get this question a lot, how much money should I have saved up by certain ages? So I've started showing people this. It's a metric that's used in our industry as a good gauge of how many times of your annual income should you have invested by certain points. So how you read this is a 30-year-old should have half of their annual salary invested, okay, in your 401k or some other vehicle. A 35-year-old should have the equivalent of their salary invested. A 50-year-old should have 5 times their income invested, and then a 65-year-old at retirement age, 11 times your income. So it's just, it's just a general metric, of course. So certainly, meet with me or talk with us if you want to do some more in-depth retirement planning. That's majority of what we do here at Everhart. But I do like showing this to give you an idea, am I close to being on track in my savings quest? So how are Americans building wealth? 99% of people in this country have done it through uh, small business ownership, investing in real estate, or owning stocks. All right, so we're going to spend the majority of our time talking about stock ownership, and then I'll get into real estate toward the end. There's pros and cons to each of these, right? There's different risks. You could argue that moving from left to right, small business ownership is the highest risk um, of these three, but it would have the highest return opportunity as well. So you could double the net income on your business in a year, but your business could also fail and go out of business. So there's a huge variance of what your return could be. It could be 100% on the plus side or 100% on the downside. Real estate, again, here we're talking about investing in real estate, not just owning your home. So, typically through apartments or single family properties, you're renting that out, you're generating income off of it. Um, this is going to depend on if you are still paying a mortgage on that property, what your maintenance costs are, expenses to yourself, and then what you're charging for rent. And then, stocks would probably be of these three at least a little lower risk. I know we've seen big swings in the stock market before, but on average, you've earned about 10%. That has still outpaced inflation by a lot historically. And I'm going to show you that right here with real rates of return over the last 200 plus years. So what's a real rate of return versus a nominal rate? A real rate just factors in inflation, which I stress the importance of that here at the beginning. So stocks have returned about 10% per year on average, but their real rate of return has been 6.8%. So inflation typically does around 3. So that brings it down to a real return of 6.8. Well, if $1 in the year 1802, it's kind of funny to look over 200 plus years, but there's actually accurate data here going back that far that we've pulled up. $1 turned into over $2 million um, by the year 2023 if it was invested in a broad stock portfolio. If you had that money invested in bonds, it grew to about 14 or $1,500 compared to $2 million, and your real return was 2 to 3%, depending on the type of bond you were in there. Now, gold and the dollar just sitting on cash, it really hasn't uh, generated any real return, right? You see, gold is at 0.6%. Your $1 turned into $4 over 200 years. That's your real return. So you're not increasing your purchasing power or building wealth historically by owning gold. Now, I know gold and silver have exploded these last 12 months, but anytime you're investing, you want to look at long periods of time. And even with that explosion, um, that's going to bump up these numbers slightly, but we're looking at, a really long period of time here that gold has not been a great way to build wealth. And then if you're just sitting on cash, you're losing money. Um, Negative 1.4% real return. So not to say I don't want to say that all of your money should be 100% in stocks. Maybe for some people that makes sense. The younger you are and the further out your time horizon is until you're going to use this money, typically the more aggressive you want to be, right? But you want to have some money in cash as an emergency fund. If you want to have some money in precious metals, I'm not going to fight you on that. I probably wouldn't have the bulk of your portfolio in precious metals because you can see, it hasn't been a great way to build wealth over time. Even bonds, most of our clients who are entering retirement, you're going to be in some mix of stocks and bonds. The bonds are great because they give you some protection in a down market, right? Typically, when stocks are down big, bonds hold more steady, or maybe bonds even have a slight positive return for that year. So it is nice for those in retirement to kind of control those swings. But bonds, we would say, have not really built wealth. It's through that stock ownership. So why have stocks outpaced inflation by so much over this extended period of time? It's because the companies that make up the stock market have increased their earnings or their profitability consistently over time. So if you go back to the year 1960, this is looking at the S&P 500, so it's the 500 largest companies in the US. In 1960, for every one share of stock that was issued, there was $3 of profit generated off of that by these companies. Well, then in 1970, there was $5.51 generated for every one share. Well, then it jumped up to $15. You can see every decade there's been a pretty consistent doubling of that profitability. And just from 2020 to 2025, that number almost doubled in 5 years compared to 10. So this is, what is that, 65, 66 years of data. It's proven to be a driver of the actual price of the stock market. And that's what affects your investments, right? If you were to overlay the actual price of the S&P at the bottom of this chart, uh, it's pretty consistently doubling every decade as well. And the S&P, sits, I believe, a little under 6,000 today. But if you go back to 1960, the S&P was sitting at, well under 1,000, probably a few hundred was the price of the index. So we want to own stocks for the long term. It's not the most exciting way to build wealth, but millions of Americans have been able to do it that way and set themselves up really well for the future. If you're investing in stocks, the short term is high risk. The long term is not. I love showing this chart because I think it hits the point home, but we've got 80 years of data here going back to World War II. The best 1 year return for the stock market was a gain of 50%. The worst year was a loss of almost 40%. So if you're investing money for 1 year and you own, the broad stock market, there is a huge range of outcomes, a 90% range of outcome. If you had $100,000, you might have ended the year with $150,000 or only about 60,000. But you can see as you lengthen that time horizon that you're invested, the fluctuation really shrinks in. Even after 3 years, the best return was about 30% per year. The worst was about 15% decline per year. At the 11-year mark, there's never been an 11-year period of time where stocks have been down. Okay, so that's important because if you have more than 10 years to invest your money, we would encourage you to be aggressive. The best 11-year stretch was 19% per year. So to use that rule of 72, you're doubling your investment a couple times over that 11-year period. And then over any 30-year stretch, the worst 30-year stretch in the history of the stock market was you gained 9.6% a year on average. I think that's kind of funny. I hear people say I lost all my money in 2008 or 2001 or when COVID hit. The only way you lose money in the stock market is if you sell. Okay, so we need to have some protection when you're in retirement because you're taking withdrawals. But for those of us who are in the wealth accumulation stage of life, we're okay with those ups and downs. Stay invested. That's what gets you the higher rate of return over the long run. And then, about 3 out of 4 years are positive when you own stocks, but 1 out of 4 is going to be negative on average. So this is every year plotted out by their return. You can see the majority of these fall in between a negative 20% return and a positive 40% return. There's a few outliers, 2008, and then some years in the 50s and 1930s. But most of these are negative 20 to positive 40%. All right, so very simple formula to building wealth through stocks. Live beneath your means, invest the difference, so your excess cash flow every month into a diversified portfolio of stocks. That's kind of a jargon phrase, but diversified means you own different types of companies and you own a lot of them. So we want you to own thousands of companies inside of your investments. And that's done through investing in funds, which is the most common way that your 401k is going to operate. But you'll own, large cap US funds, which would be, your largest US companies like Exxon and Amazon and Tesla and Coca-Cola. You would own mid cap and small cap, which are some smaller companies. You'd have some invested in international, maybe some bonds in there. That's diversifying your money and do this for a long period of time. Okay. So it does not have to be overly complicated to build wealth through stocks, but you do need to have a positive cash flow each month, like I referenced at the beginning. If you don't have any money to invest, then you can't grow it, right? You need to have some money each month to put into a portfolio. So a couple of keys here as well. Peter Lynch, famous investor, says the real key to making money in stocks is to not get scared out of them. When we see a 20 or 30% decline in the stock market, the worst thing you can do is get out, sell your investment, and wait for things to settle down. I hear that all the time. One, things never really settle down, right? At least the last 6 years since COVID hit, I don't know if there's been a settled down period of time over those 6 years. But two, typically you're too late getting back in. Once things have settled down, the market's already started to recover. It's very difficult to time it and get invested at that low point. So we talked about diversifying your money. Um, Build out an automated investment plan. So your 401k is great for this because every paycheck, you just have a certain percentage that goes into your investment. But if you invest into an individual retirement account, maybe you could just have an automated monthly contribution, or same with like a taxable brokerage account. If you automate these things, makes it much easier to accomplish each month. Try to take the emotion out of investing. Um, Typically, good decisions are not made based on emotion. All right. It's normal to have some years where your investment goes down in value, but it does not mean that you're doing anything wrong. Stay invested, try to have patience, focus on the long term. Don't try to time the market. So this is changing your investments frequently based on what you think is going to happen in the economy and how that's going to affect your investment. I do this stuff for a living. I'm a certified financial planner. I do not try to time the market with my investments because I would not be good at it. There's some advisors out there, or you know, uh, people in the financial media, make their market outlook predictions each year as to what the gross domestic product or the growth of the economy is going to be, or how the stock market's going to move for the year. They're almost always wrong, right? Or they're conservatively optimistic for the year. That's my least favorite phrase that's thrown out. But they're almost always wrong. Nobody knows what's going to happen over the next year. COVID hit in 2020 in March, and we saw a 34% decline in 1 month. Do you think any single person predicted that the stock market would have ended the year up almost about 15%? No, they would have all predicted that it's going to keep going down, or it's going to end the year negative because it's already down 34%. So if you really want to stay invested, we don't know when these recessions are coming. We don't know when the recovery is coming. It will come. There's only ever been temporary declines, but please don't time the market, and then stay invested for a long time. All right, so we've covered stocks pretty heavily. Let's take about 5 to 10 more minutes and wrap up here, and then I'll open it up to some questions. So, investing in real estate. The way that people are successful investing in real estate is using leverage. So, using somebody else's money to increase your rate of return. And this is going to be the bank's money instead of your own money. Got two examples here to explain this power of leverage. Example one, we buy $1 million property in cash. We don't take out a loan, just put $1 million in cash, and we pay for the property. There's no debt on it. We generate a gross return of $100,000. So maybe we generated 100 grand of rents for the year. There's no interest expense because we don't have a loan on the property. So your net return is the same as the gross return, $100,000. Now, this is a simplified example because you're going to have maintenance and property costs that will eat into that net return. But we're gonna leave those out for sake of the example. So you've got $100,000 net return. You invested a million. That's a 10% rate of return, right? 100,000 divided by a million that you put into the property. So not bad. You got a 10% return. That's pretty solid. But example number two is what we want to focus on. So here, you're buying the same exact $1 million property, but you are putting down $250,000 of cash as a down payment, and you're going to borrow three-quarters of a million from the bank as a loan. All right. So it's the same property, so you generate the same gross return. Now you're paying this loan back to the bank. So just your interest at a 6% rate on this loan would be 45,000 a year. So that does eat into your net return. So here you're only profiting $55,000 compared to the $100,000 if you just pay for it in cash. But your rate of return is much higher because you only invested $250,000 of your own money. So $55,000 return divided by your investment, now you've got a 22% rate of return. The whole idea here is that then you would take that the remaining $750,000 of capital that you didn't put into that property, and you would invest that elsewhere, whether it's buying three other properties and doing the exact same thing, or putting that 750,000 in the stock market or into your business. Uh, but this is the power of leverage. You're enhancing your rate of return by using the bank's money on these properties. And if you're generating a 22% return, you're doubling your money in 4 years or a little quicker. So, when you're getting into real estate, you want to make sure you're doing your research, you understand what you're getting into, because there are different risks involved here as well. The big ones would be, you gotta have reliable tenants. If you don't have anybody that's paying you rent, you're not generating any income. Um, you're going to have maintenance costs. Things are going to break down that you have to pay for unexpectedly. So that's a risk. There may be added time and stress for you having to actually manage the property. And if you hire a property manager, then that's going to eat into your net return. So you probably want to run through some numbers before you pursue this just to see what that return on investment is going to be and how that would compare to if you were going to, invest in a business that you own or invest this money in stocks. All right. Couple last thoughts on wealth building here. So mentioned, build in those automatic saving plan to your 401k or other types of investments. Don't be concerned about displaying a high social status. Um, Dave Ramsey talks about this, but the millionaires, they don't drive expensive cars. They don't have the nicest stuff typically. They're doing just fine, but they're not flashy with it for the most part. That's how you generate wealth. We looked at the beginning, you need to have more money coming in than what you're spending each month. So if you have all these nice things that you have all this debt on, it's really hard to invest your money and grow it. So try to be frugal. That's going to free up your cash flow. Follow that rule of 72. And then just watch out for big purchases. Try to manage your debt. I included this on here as well because I think this goes along nicely with the topic today. You can scan the code here for a more in-depth article that we wrote on the idea, but it's really an order of operations to setting yourself up well financially. So 1 and 2, you want to pay your bills on time, of course, have an emergency fund. Bare minimum would be $1,000 in cash. Ideally would be at least 3 months of living expenses. That is key because life's going to happen at the worst time. Your car breaks down, um, your roof needs replaced, whatever it is. You need to have cash on hand to avoid putting that on a credit card and not being able to pay off the card that month. Okay, from there, you're going to invest enough in your 401k or your health savings account to get the company match. Then you're going to work that debt snowball that we talked about on all of your non-mortgage debt, like credit cards, car payments, student loans. When you've got the non-mortgage debt paid off, you go back to your 401k and you bump up your savings rate to that 10 to 15% range. Once you've accomplished that, we're going to look at college savings for kids and taxable brokerage accounts, just another type of account that can give you some liquidity or access to that money pre-retirement. So, like I said, we go through financial and retirement planning with folks every day. Hopefully, there's a couple things that you can take away from this and implement into your own finances, and start building wealth for yourself. So, I'm going to switch over to taking some questions. It's about 10:40, so I will stay on until the top of the hour if needed. But feel free to go ahead and type in some questions if you have it into the Q&A box, and I'll start going through these. If you need to jump off, thank you for your time today. Hopefully this was helpful for you. All right, so first question, will you have your contact information listed somewhere in the call so that we can reach out directly to arrange an appointment? Yes, here it is. Call us here or email us. This is our 401k helpline, and we will get back to you shortly if we don't answer. You go back to the previous slide for a moment. There you go. Try to use this Q&A chat if you are putting a question in for me. Thank you. You're very welcome. Anyone have a question? No bad questions. It can be relating to anything that we went through today. For saving for retirement, Roth versus traditional IRA savings, what do you suggest? It's going to depend on your personal situation. One is not better than the other, I would say, but you're mainly looking at your tax bracket, and you're trying to compare your tax bracket today to what you think your tax bracket is going to be in retirement when you're taking withdrawals. And if you project that your tax bracket is going to be higher in the future, then you'd want to utilize a Roth contribution now to pay the lower tax now. If you project that your bracket's going to be lower in the future, then you would want to use the pre-tax. Okay, so you're really just trying to pay the least amount of tax possible, and you can do that when you're in the lowest bracket. But Roth money grows tax-free, of course, for retirement. All right. For the generalized help email address, who does that land with? I have a document I want to send over, but I want to make sure it's secure / confidential. Can you just send an email to that helpline and just say exactly what you did here, that you need to send over a secure document, and we will send you a secure email chain that you can just attach it to. Because yeah, if it's confidential, let us send you that so that you can attach it secured. I missed the first half of the webinar. Will the recording be available today? Typically tomorrow. We'll send that out to you. So yeah, as long as you were signed up and attended, then you'll get an email with the recording and the slides. Great presentation. Appreciate your information. Very easy to digest. Great. Thank you. Glad you found it helpful. I have borrowed from my 401k. Can I ever recover? I'm over 55. Yes. I mean, yeah, you can always recover. Sorry, I don't mean to laugh. I just, the phrase was a little funny there. Yeah. I mean, you may have set yourself back a little bit. But if you can get that loan paid off as quickly as possible and then aggressively save into the 401k, I mean that's the best way to go about it. Feel free to reach out, give us some more information, and I can help you develop a strategy. Okay. Any other questions? What was the 72 step you mentioned? Can that be reviewed again? Yeah. Rule of 72. Okay, so here's that rule. It's just a simple math trick to tell you how quickly you can double your investment. Okay. Um, and your annual return is determining how quickly that will double. So if your rate of return is higher, then money will double quicker. And the nice thing about, calculating a double of your investment is that it has that exponential growth to it, right? So let's say you're 30 years old, you're going to retire at 65. So you have 35 years for your money to grow. If you're earning 10%, then 72 divided by 10, we'll just call it 7, takes 7 years to double. So you got 35 years. You could fit 5 doubles into those 35 years, right? So if you've got $100,000 invested at age 30, that doubles 5 times, it would go to 200,000, 400, 800, 1.6, 3.2. So just 5 doubles at 10%, 100,000 grows to 3.2 million. So pretty powerful. And that's without you even contributing anything else. So it speaks to like time in the market is so crucial. If you are a young investor on this call, please start saving now if you can, because that money has the longest amount of time to grow for you. If I retire and we'll get a nice payout for unused PTO, would that be best to invest into my 401k with that money? You certainly could if you don't need it as a payout. Just make sure that you're staying under the IRS limits for the year. So this year it's 24,500, or if you're 50 and older, it's 32,500. But if you don't need the money, that would be a good use of it into the 401k. Good questions, everybody. Okay. Well, I don't see anything else. Thank you so much for joining. Hopefully this was beneficial. You'll get a recording and the slides sent to you. Please, I'm going to go back to this contact page. Please reach out if you need anything. That's what we are here for. And then next month, we're talking about interest rates. So this will be a new topic for the university program. How does that affect buying a home, how does it affect your investments? Um, so that'll be great. February 24th. So tune into that one. All right. Thanks, everybody. Have a great Tuesday.